The CBOE Volatility Index, the VIX, closed at 1765 on June 29th, down 4.1% from 1841 the session before. That is a meaningful single-session compression. The VIX isn't a stock price. It's the pricing engine for put and call options across the entire S&P 500. And when it drops this sharply in one session, the cost of protection falls with it, risk appetites tend to expand, and sector flows start to rotate. The VIX is calculated by CBOE from the implied volatility of a rolling basket of near-dated S&P 500 options, both puts and calls, across a wide range of strike prices. The index is quoted as an annualized number. A reading of 17.6 translates to roughly 5.1% in expected monthly movement for the S&P 500. That is what you get when you divide the annualized VIX by the square root of 12. Critically, the VIX is not directional. It doesn't say the S&P 500 goes up or down. It measures expected magnitude in either direction. Since its inception in the early 1990s, the VIX has averaged around 19, based on CBOE historical data. A reading below 20 is broadly considered a calm to normal regime for the index. Below 15 has historically been associated with complacency, the kind of low-vol environment that preceded the February 2018 volatility spike and the quiet stretch immediately before the 2020 market disruption. At 1765, we sit in the calmer half of the normal range. Not in complacency territory, but no longer in elevated concern territory either. Three macro readings provide context for the compression. The Federal Reserve's effective funds rate stands at 3.64%, a level that reflects meaningful easing from the cycle's peak and reduces pressure on equity valuations. The 10-year Treasury yield at 4.4% as of June 25th has held in a stable band without generating rate shock headlines, and the Consumer Price Index stood at 332.4 on the index scale through April, with no fresh acceleration in inflation to force the Fed back into a tightening posture. When those three variables are in relative equilibrium, options traders have less reason to pay up for protection. Lower implied volatility has direct mechanical effects on equity positioning. Institutional funds running volatility targeting or risk parity strategies increase equity exposure automatically when vol falls, because the same dollar position now registers as lower measured risk. A mechanic built into how those funds size positions. That flow tends to favor high beta names most. Large cap technology, NVIDIA, Apple, Meta, and Microsoft, gets the first benefit, followed by small cap growth and high yield credit. Defensive sectors, consumer staples like Coca-Cola and PG, and utilities like Nextera, typically lag during these phases as hedges get unwound and rotation into more growth-oriented names accelerates. For options traders specifically, lower vol means lower premium across the board. Premium sellers, those writing covered calls or cash-secured puts, collect less income per contract in a compressed vol environment. Conversely, investors looking to initiate protective put positions or collar structures find the entry cost lower than in elevated vol regimes. The asymmetry here is timing. The cheapest moment to open downside protection is exactly when the market appears to need it least. A VIX at the current level is not a guarantee of calm ahead. Several triggers could push it sharply higher. The unemployment rate held at 4.3% as of April. Any deterioration in the labor market would reprice risk sentiment quickly. The 10-year Treasury yield at 4.4% leaves the bond market sensitive to any inflation surprise above the current trend. And VIX spikes are historically asymmetric. The index can move from calm levels into the mid to high 20s in a matter of days when macro conditions shift unexpectedly. The VIX's move on June 29th reflects a market pricing in relative quiet for the month ahead. That is not an investment recommendation. It is a snapshot of where implied volatility sits right now. What it confirms is that traders are not paying up for protection, and that shifts the environment toward risk exposure rather than defense. Whether that assessment holds depends on what labor data, inflation prints, and Fed commentary deliver in the weeks ahead.